Our next featured speaker, Lewis Johnson, is Co-Chief Investment Officer at Capital Wealth Advisors, an independent financial advisory firm serving families and entrepreneurs through wealth advisory, estate planning, and family office. Lewis is also president, co-founder, and partner of Fundamental Global Advisors, LLC, an alternative investment manager. Johnson is author of Trends in Tail Risks, a bi-weekly Capital Wealth Advisors publication dedicated to the belief that deeper and broader knowledge has the potential to drive superior investment results. Additionally, Lewis has been featured in the media on CNBC's Squawk Box, the TD Ameritrade Network, and Real Vision. Please join me in welcoming Lewis Johnson.
Hey, good morning. Can everybody hear me okay? Great. Well, sure. So what I'd like to do with you today is just share with you kind of the things I've learned from 20 years of investing in the markets, and in particular in cyclical areas. And of course, fewer things in the world are more cyclical and have more volatility in the real estate market, as I'm sure all you good people understand. So what I'm going to do today is just walk you through the very simplistic framework for how we think about investing, how real estate has its own kind of specific set of volatility, and how we see the future going and what we think is the best way to kind of navigate through those uncertain times, as we say, riding the real estate roller coaster. Well, so this gentleman, I forgot his name. I think people think he's a smart guy about investing. But his framework seems to be that there's a good time to buy and a good time to sell. And the question is, how do you think about, fear and greed, which I can promise you drive all markets and all assets. So the question is, how do you think about navigating through that? And so that's what we're going to try to talk about. So in terms of the emotions of fear and greed that end up driving people, that's really the issue. I think if we can agree that that it's very important to understand these forces that are driving asset prices up and down, it's a reasonable thing to think about, well, what's our framework? How do we think about, when to be fearful, when to be greedy? So one thing that dominates my thinking kind of in all respects in the work that I've done in the past really has to do with understanding, cycles. And cycles are really nothing more than kind of natural change. This can be the seasons in this example, or night and day is a cycle of as another cycle. Where the tides are, they're coming in and coming out. And so one of the things that I have studied, cycles for my entire career, and I suppose maybe before that, is really trying to say, look, what are the things that we can understand that change that maybe other people don't kind of see coming? Because frankly, the best opportunities in the market are when you know somebody that somebody else, something that somebody else doesn't. And I think one of the easiest ways to do that is to study history and to understand how cycles can create unexpected change. Because when everything lines up, like this gentleman learned with his pumpkin, it's great to have outsized returns when all the different aspects of investing kind of come together. And that's really kind of what we focus on and what we try to do on behalf of our clients is to understand that that valuation, which of course is kind of what you're paid for an asset. This is a really important point. I just want to take a minute to talk about this. So I think this is particularly true in the real estate market. I mean, the building doesn't change, right? I mean, it's the same building. At the peak of the cycle, it's worth a lot more. Trough of the cycle, it's worth a lot less. So clearly, that the physical building itself or the assets around it haven't changed. The assumptions people have in terms of the future, how they're valuing that, what they're concerned about, those are the things that are really driving cyclicality. And so from my perspective, there are a lot of people, who worthily devote their time to figuring out all the, the different details that go into driving the fundamentals of that particular building. I think about the context in which it's associated. That, to me, has been the bigger driver. So the first aspect, of kind of unexpected change and being able to think constructively about that is really just to go back and study history and say, what's happened, in the past. And thankfully, there's a lot of good literature, some of which I've studied exhaustively, and it's all out there. So I'm not going to kind of bore you kind of going through, these four major kind of cycles that are in economic history, but there's actually quite a bit of empirical literature behind each one of these. The one that's going to be most interesting for us to talk about is the issue of the infrastructure cycle, or the real estate cycle, and we'll talk a little bit in more detail about this, because I think this is really the heart of the matter when it comes to driving volatility in the real estate market. Before we do a bit of a deeper dive, I don't want to scare people with the volatility of the chart, but the point I'd like to highlight in this is these are those main kind of cycles that we outlined, and it shows the volatility of how they kind of interact, because each one has kind of a different period. One is 4, one is like 9 to 11, one's 16, one's kind of 50, and these interact in complicated ways that are not always obvious to figure out. But again, what we're really trying to do is to understand, what are the cycles and the change that we can get ahead of, that we can reasonably anticipate based on kind of a study of history. And so I guess the big point I'd like to leave you with this is that these cycles do create a lot of volatility, and that if you can find a way to master that, it can be a great asset for you. So this is the gentleman for whom essentially the real estate cycles is named Simon Kuznets, won a Nobel Prize in economics. And like many of the people who came of age in the 30s, during a devastating time of the Great Depression, there were a lot of people in the economic profession that looked around the world and said, my God, what happened, to us? Like everything was great in the 20s, and then the 30s were sprung upon us. And so the study of cyclicality and change and the things that, kind of broke and went bad in the economy were a big part of how people thought. So one of the things that he was able to identify, and to the extent to which this is clear in the literature is really kind of stunning, is the periodicity of peaks, and then how this disappeared on me. There we go. But so again, one of the things that is to me very interesting about these real estate cycles, literally, you can go all the way back to 1920, and frankly, you can go back further. And so essentially, it's every 16 to 20 years, you have these, big credit-driven infrastructure and real estate cycles. And now I would believe this pertains to, perhaps to, residential construction and things like that. It shows itself most clearly in the residential markets, and frankly, to the extent that they're both driven by leverage, that's pretty common. But what I would like to highlight is the last peak was essentially, 2006. And so if you take this framework of every, say, 16 to 20 years, which is kind of work like clockwork, although clearly there's, say, like a 4-year spread there, we're kind of due the next peak, 2022, 2026. This is still kind of in the future. And again, this is one of the bigger real estate cycles. There are other cycles that can kind of peak in the short run, but in my experience, if this was all you understood about real estate investing, that might be a very handy thing for you to know. And why I say that, one of the things I've studied, Napoleon Bonaparte, took over all of Europe. A lot of people might not understand, but his saying of timing is everything is I think really appropriate for real estate. So think about it. What if somebody would have told you in, say, 2005 or 2006, hey, you're 16 years into a 16-year upcycle, you might want to lighten up. I think that would have been useful. Certainly that was useful for our investing during the financial crisis, And so obviously, it really can be that simple. Sometimes that's the most stunning thing to me about investing, is that there can be 2 or 3 principles that are very obvious. Just the application and the discipline application that can be tough. And also, again, this has a lot to do with human experience. We talked about human emotion of fear and greed, right? And there's an example I'm going to be able to walk you through in terms of how this works through the market and kind of why we have this framework. So, perhaps, one of the most famous real estate investors, Sam Zell, sold his large real estate company, I think it was early 2007. I drew the headline from a newspaper article at the time. What I wanted to show was when he sold and what happened afterwards. And so, clearly he was able to nail that really well. We don't have to go into the specifics of exactly how that took place, but I do think it's interesting. You see the chart, you understand why he's smiling, is that basically, within a year of selling, it was a devastating downturn. That he was able to mitigate because he was able to sell at the appropriate time, and people who, frankly, to whom he sold, came to understand the power of cyclicality in real estate, and I think that's probably something they won't be forgetting for some time. So anyway, what I want to do is just kind of outline the 4 things that we watch as we kind of think we're heading into a more sustained, a longer peak in the cycle, but something that still lays in our future. So what I want to do is share with you kind of the 4 guideposts that guide our thinking, and certainly they were useful for us prior to the financial crisis. I think they'll be useful again, 16 years from the time that they were last useful. But of the 4 components, the first is something that investor George Soros calls reflexivity. And so, of course, before he became a lightning rod in the political arena, he was actually the most successful investor in the history of the world in terms of his returns. Okay, great. So basically, I've got the full text here from his book, Alchemy of Finance, he wrote in 1987. But basically, he was outlining this idea of reflexivity. And credit and real estate, it's one of the most reflexive markets in the world. And so basically what this means is it's highly, highly subject to booms and busts for very definable reasons. And so if I were going to highlight just a couple of points that I would make, the point he made in 1987, ahead of course that real estate cycle, and why he traded the financial crisis so well, is he notes that there are certain kind of assets that he calls reflexive, and what that means is that the value of the asset is highly dependent upon how people think about it. And the example that he gives here, he talks about real estate, that basically, and I can give you an example if this comes back about how this moves. But basically, the principle is that this is a very highly cyclical asset, and so it's highly subject to booms and busts, and the key driver of that. And so if you want to learn more about that, for instance, I'd say Alchemy of Finance is a great book. It's very dense. It took me 5 times to get it, but it was worth the time. But what I want to highlight here for you is this is U.S. mortgage credit growth year over year. This goes all the way back to 1946. So a couple things I would like to highlight is, again, this is really that second pillar of what drives, I think, predictable volatility in real estate. Again, the first is that it's a reflexive asset class. It's prone to be volatile. The second is that it's very credit sensitive. So, of course, our earlier speaker was talking about the role of credit and how the cost and quantity end up driving these cycles. The point I would make, you remember we talked about every 16 or 20 years you can see the peak in credit growth. Historically, it's been almost 15%. Of course, you can see the absolute cliff dive that took place in 2006, 7, and 8, which of course drove the biggest real estate crash in 3 generations. I think, again, with a large part of this framework, that was not necessarily a surprise for people who had studied these cycles and understood, again, that they were 16 years into a 16-year cycle. But if you look now, year-over-year mortgage growth is literally 3% per year. That's not exactly peaking. And so I'm not saying that real estate wouldn't suffer in whatever kind of downturn we may be due at the end of this business cycle. But the biggest crashes are driven by the sudden withdrawal of leverage. And given that there's no leverage, it might be kind of hard to drive that, right? And this really gets back to the third point that I want to make about this is again human behavior in these cycles of fear and greed, right? So let me kind of walk through this. There's a great quote from Twain, one of my favorite authors, right? That history doesn't repeat, but it often rhymes. And so if you think about, you may have heard the saying as well that generals fight the last war. Well, I think in the study of real estate, so everyone thinks back about the cycle before, because frankly, most people have only, say, traded 1 or maybe 2 cycles in their career, and so when these things happen, they're like shocking and terrifying because people weren't expecting it. But just if you go back and you think about, say, the time that I've been in the markets, when I started working, my first employer in the investment research business, T. Rowe Price, remember the internet bubble was kind of peaking and blowing up. The Fed cut interest rates. There was a tremendous amount of enthusiasm about equities. They were annihilated. It was absolutely horrible for people. But real estate, amazingly, didn't really have much of a down cycle, right? And so there were investors who blew up in equities, and real estate was fine. And these people thought, man, this thing's amazing, right? Because this never goes down. And that was one of the things that, like the entire economy and the stock market can crash, and here's real estate doing awesome. And so again, people are making that mistake of fighting the last war. I mean, I think you need to go back and study kind of, the war before, right? That, I think, is the point that Twain is making, is you can't just look at, say, the last cycle. You have to look at kind of, the cycle before, because that's the nature of these long 16 and 20-year real estate cycles. So the third part in thinking about, say, an upcoming peak or navigating this volatility has to do with sentiment. So this was cover Time magazine. I think it was June 2005. Of course, you can see the gentleman, he's hugging that house because it's never going to go down. And if you see what the sign says, it says, will your house make you rich? Super hot markets. This is the kind of thing that you see like at the peak of the cycle. You don't see a whole lot of this right now, in real estate, but certainly at least in residential real estate, because of course people just weathered, essentially what could have been in many markets 40 to 50% downdraft in their real estate values. So people are kind of terrified that the next cycle is going to jump out and bite them. Number one, and number two, if you tried to get like a mortgage loan lately, the process is a little more difficult than it used to be, because before, like if you could fog a mirror, like you were fine, right? No, honestly, it was drive-by mortgage. It was drive-by mortgage financing, right? Like if any of you guys have seen The Big Short, which is actually not a bad movie for someone who lived through the financial crisis, you remember there was a part where they were in Florida and they were in a gentleman's entertainment situation, and the lady who was performing for them like outlined that she had 6 or 8 spec houses and something like that. That's kind of like a true story. I mean, it was not apocryphal. I mean, so but again, how could that possibly be? It was because what was the math that was going on, both in terms of the bankers' minds. No offense to the bankers here, but in the bankers' minds as well as the people that own the real estate, they were like, wow, we just had this huge stock crash and my real estate goes up 10 to 15% every year, so I should have more of this, right? And so the banks look at it and say, wow, this stuff never goes down, never been price decline since the Great Depression. This is literally can't lose. And so like I don't care if what was it, the ninja loans, right? No income, no job, no nothing or whatever. Because they were like, hey, look, if this guy's a total deadbeat, the house will go up 10 or 50% value, I'll foreclose on it and I'm still making money. So of course all that was wrong. And it was 16 years, or at this point, 15 and a half years into a 16-year cycle. The clock was ticking. It was dangerous. But as so often happens at the peak of the cycle, that cycle of fear and greed really gave way to greed, and that tends to not end well. And so the fourth, aspect of terms of how we think about, preparing for the next cycle or thinking about the cycle, my experience is that, just like there's a fundamental set of drivers that make things happen, there's kind of a leading indicator for everything that happens as well. And to us, one of the best leading indicators is the equity market. Because I can tell you, I've had to make my living for 20 years trying to invest intelligently in it. And the tough thing about equities is they're always looking ahead. Very rarely are they reacting to today's news. What they're actually trying to do is price in the future 6 months ahead, 12 months ahead. So the chart that you're looking at is a chart of the home builder equities from Bloomberg, and you can see that beginning in the horrible stock recession we had in 2000 when the equity market lost half its value, the home builders went up dramatically. I don't think I have the numbers on here, but it was like one of the leadership groups of the market. But here's the point I would like to highlight for you is look at the peak, July 2005. Now the fundamental peak in the market arguably didn't take place until the second quarter of 2006, and that's when mortgage growth had its first sequential decline from 16% year over year to 15%. The problem, with equities, right, is they were 6 or 8 months ahead of the first fundamental decline. This is why they can be very tricky. But this is also how they can be very useful to you. If you are active in the underlying real estate market, if you kind of want to have a sense for where that underlying market is going to be in 6, 8, 12 months, there are many worse things you could do other than watch equities. So of course that was an 85% decline. It was a disaster. But we think that's setting up a more normal market now. And this is kind of a follow-on point I'd like to make relative to my earlier point, right, which is that if you think about those home builder equities, which were correctly anticipating a peak and decline in the home mortgage market, they peaked in July. January 2006 was the first point where it began to decline. I mean, real estate prices didn't actually go negative until 2007. I think it was about January 2007 or so. So again, the equities gave you kind of an 18-month lead on that. And I remember being in the investment business at that time, and a lot of people were scratching their head because the home builder equities, you know, the earnings would go up 10, 20, 30%, and stocks just kept going down, you know, and nobody cared. And a lot of people were looking at that saying, this doesn't make any sense to me, you know, and you know, I think if you think about how forward-looking equities are, it kind of made like a ton of sense. But of course, you can see there was a dramatic decline, and again, this was driven by the culmination of those kind of 3 or 4 factors, right? As Soros noted, because real estate has an inherently high degree of leverage in it, how people think about the asset, which is driven by sentiment, and to the extent to which it's attracting credit flows, this is a huge deal in terms of how it drives it. So of course, everyone everyone became much more circumspect about the kind of loans. I don't know if you guys remember seeing this. I remember after Chairman Bernanke retired from the Fed, I remember there was a newspaper article out that said like he couldn't get, you know, like a mortgage because he had, you know, just changed jobs and he didn't have the credit profile necessary. You know, and no, this is a true story. You should Google this. It's really extraordinary. You know, but again, if you think about the fact that this is an inherently highly reflexive asset and that its peaks will be driven by credit, and credit's not really doing anything right now, you know, it doesn't mean that it won't suffer, you know, a slowdown, but I don't foresee the same kind of calamitous decline that we saw, because frankly what that's going to take is real estate weathering a downturn, okay? And there'll be a whole new crop of folks that come in 3 or 4 years and they're like, man, this is amazing because we had this downturn, it didn't go down, and all it does is go up. And they're going to have to learn. They're going to have, I know it is funny, but it, you know, this is the world I live in, believe me. You know, but you know, again, I think, you know, I think it can be very, very straightforward. Again, you know, 16 to 20 year cycle, kind of where are you in that? And you know, these drivers and indicators of credit, leverage, you know, they're not extreme at this point. So, so the point I'd like to make, you know, kind of big picture, just in summing up, is that you know, almost everything in our perspective is cyclical. Real estate is probably one of the most cyclical of the asset classes because, as Soros notes, it's highly reflexive. And because credit growth is very muted, it's very difficult to see a tremendous fundamental crash in this, similar to what we saw last time. Although, I would be willing to bet you that if we were in this room 2022 to 2026 and you start seeing some of these leading indicators, there'll be a new crop of people who didn't get crushed in the prior down cycle, and they'll be you know, selling you like rainbows and daisies and fluffy white clouds and bunny rabbits, you know, and that everything's gonna be fine, and that all those, you know, and you think about it, because all the people that live through this, by this point, they will be, you know, their experience goes back 16 years, and so there's going to be a whole new crop of fresh people, and they're not going to have this experience until it gets, you know, seared into their soul, you know, which will happen. And so again, you know, our framework is this: is that you know, because this is a very cyclical asset, I think the bigger and more powerful peak lies probably in the future. Again, 16 to 20 years prior peak. You know, because it is so highly reflexive, you have to watch what's going on in the credit markets. You know, I can't speak for, you know, more non-residential, although typically the cycles are not that different. But, you know, clearly we're not seeing that same kind of rampant credit growth that creates a bubble and then a crash when it's withdrawn. You know, watch for sentiment. I think we're still a ways away from that. But frankly, most importantly, you know, the home builder equities, because you know, again, I study cycles, and I remember 2005, and I remember watching the builders go down, and like the earnings go up, and everybody was bullish, and I remember thinking, oh boy, okay, you know, like the clock is started, you know. And so anyway, this is how we think about real estate. This is kind of where we think we are in the cycle. These are the drivers and the things we think are important. You know, I'd be happy to answer any questions or talk about this or anything else I could be of use to. Yes, ma'am.
So, this is fascinating. As a scholar of management, I understand human behavior, but I wonder if political or historical type artifacts or generational, like millennial. So if the peak is always 16, 20 years, it would imply there is a very limited effect of outside influences compared to influences. But so then you read that millennials are not buying houses, right? So they're all living with their parents. So there are effects that would make a difference in that cycle based on the historical context we're living in. How much can they affect?
Sure. Well, were you guys able to hear the question okay? Okay, so the question was essentially, you know, with all the idiosyncratic factors in the world, you know, millennials not, you know, buying houses, living with their parents, or changes in finance or sentiment or whatever, you know, how to, you know, I guess, is there a way or a discipline to kind of figure out what those different kind of forces are, or how they're different kind of from cycle to cycle? Well, yeah, that's a great question. And so again, you know, if you go back to the Twain quote, right, that they don't repeat, but they rhyme. You know, but what I would say is you know, clearly the growth rates and the amplitude, they can all be different, but the things that I outlined are the commonalities, you know, is that credit drives huge bubbles and huge crashes. It's, at least in residential, you're not seeing that so much. And also too, I think part of it is the natural obsolescence, you know, cycle, right? That's one of the big things of cycles. And, you know, a big physical plant like that, you know, 16 to 20 years kind of on average in terms of, you know, when these assets start to mature. And so there's a lot of idiosyncratic factors within that. But frankly, in my experience, I like to ignore those because that's the situation that so many people find themselves in, because they didn't live through the last crash. And they think, you know, what is it? There's a great quote that says what the most expensive words in investing are: this time it's different. You know, yeah, you should remember that. Write that one down. This time it's different. You know, and so, you know, you hear a lot about that, and it's people who are driving these bottoms up thing. Well, you know, what about this and what about that? And I don't know. I mean, it's been my experience, or when I've had success, it's focusing on foundational principles. You know, in terms of timing and cyclicality and drivers. It's very easy to get lost in the weeds. And you can be successful that way. It's just that has not been successful for me. What else can we talk about? Yes, sir.
You spoke to kind of see if the down cycles come. How about the inverse of that? How do you see the up cycle come after the down cycle?
Well, the question is that what we've outlined is a framework through which it might be reasonable to expect, you know, see down cycles, then how to think about the up cycles. Well, you know, it's, you know, as important as timing is everything, you know, it's very hard. But again, what I try to think about is, you know, like when I tell our younger analysts who we train, you know, that, you know, like there's no like earnings fairy, right? You know, and that's where a company's earnings come from, you know, like they come from fundamental drivers, right? And so I think cycles are the same way. And at least in terms of these cycles with, you know, being so driven by credit, and one of the things you can watch again is just the leading indicators of what the equities are doing. And so just maybe staying on that equity example. So it was really remarkable, you know, to me as a participant living through this, to watch the home builder equities peak at like 5 or 6 times earnings, which is frankly not that expensive relative to market trades at 16, 18, 20 times earnings. And then the earnings went up and all the stocks did was go down. And there was not a single potential negative fundamental data point that you could have drawn from anything, in my opinion, until maybe 2007, early 2008. And so what was stunning is right when the fundamentals literally fell apart, the home builder equity stopped going down. Like they stopped going down in April of 2007, kind of a double bottom, and then in like January 2008. So the whole world melted down around them, and they were fine, because what they were doing was trying to, it was the market's way of trying to actually forecast the future. And because the future at that point was already a total disaster, the equities had looked ahead and they were moving to brighter times. So that's why it can be very humbling to invest in the equity market, because it's so forward-looking. But to the extent that that you guys are active in, you know, the underlying, you know, assets, I mean, frankly, you're getting a really powerful resource in terms of the outlook of the equities. You know, and so again, it would be my suggestion that as we got deeper into this cycle, and you start seeing some of these things take place, and you start seeing, for instance, you know, the builder equities really nosedive, you might want to think about lightening up a little bit. Anything else we can talk about? Any questions at all? Okay, great. Well, look, thank you very much for your time.